So we're going to go ahead and look at cost inventory and cost of goods sold and the relationship between the two. And in a time of constant prices, it doesn't really matter how we deal with inventory, but in rising prices or in price fluctuations, the way we handle inventory and cost of goods sold is quite important. And when we think about inventory, I often think about it as a barrel. And the reason I think about it as a barrel is because I imagine there's some sort of storage associated with it, which is the inventory itself. And that's added to that is the purchases we buy. And then subtracted from that or taken away from that is the sales that we have. The other way we can think about it is a T account where we have the beginning balance, we have purchases coming in and cost of goods sold going out as a credit entry. This is a debit entry. And then the ending balance would be the net of that. And you're familiar with that T account. What in this case, the way it's drawn here is it has the purchases coming in at the top and the sales items coming out at the bottom. So the accumulated here is the most recent, and this is the oldest stuff. This process, where this sales is coming from, is known as FIFO, or the first in, first out, because this is the inventory that has been here the longest, and so that's the one we're going to take out first. In a physical inventory system, this is almost always the way physical inventory is dealt with, where we take the items that were there for the longest time and we take those out first. If you imagine, say, in a grocery store, the milk associated with the grocery store, they often push the milk forward when it's the oldest. So sometimes I trick them and get the milk in the back of the shelf to make sure it's the newest or the most recent milk. But that's how they use the FIFO. And almost all inventory is done that way because we want to make sure we have don't have product that's sitting in inventory that is obsolete. Now there's another way to do inventory that's called LIFO, or last in, first out, and I draw this with an arrow coming out at the top of the barrel. So what's happening here is the purchases come in the top, and then the sales are actually taken off the top. So it's the last items in are the first items to go out. So down here there's a whole bunch of old inventory that might be there forever because we're always taking out the last items that were coming in. Now the concept is the same here in the T account. It's just that how do we value this cost of goods sold? So there, again, when I talked about the physical inventory system, we almost always use FIFO, where we take the first in, first out. But in counting methods, companies almost always use LIFO, use this concept of LIFO, last in, first out. And we'll explain to you a little bit why that is, and we'll look at both of those concepts. It's not really a big issue associated with which inventory method you use, except when prices are fluctuating. And especially if prices are increasing, then this is an important decision for the company. Now, when we look at inventory, what often happens is they have this concept of inventory layers, where we have each layer that was purchased at a different point in time and has a different price associated with it. So for instance, here we have these 4 layers, one that was bought in June, one that's bought in November, one that is bought in January, and one that's bought in April. You can see the June is the cheapest, was bought longest, the farthest, has been in there the longest. So if we have a LIFO system, we have sales that come off the top. So the purchases come in and the sales go out. So in the cost of goods sold is going to be $30 a unit. So let's say we're selling our items for $40 a unit. What we're doing is we're making $10 on each unit. In a FIFO system, though, where we take the bottom layers here first, the first in, first out, we actually are making $22 a unit. So it's much different profit associated with each of these. And so looking at this is a good way to kind of think about how you're going to be handling it. So most companies choose either LIFO. Companies can choose either LIFO or FIFO. They don't really get to choice to move back and forth between the two. They really need to make a decision about it. And in reality, most companies use LIFO for their inventory. But you can make a choice. They can make a choice about that. In times of rising prices, FIFO produces higher income and higher assets. And in times of rising prices, LIFO produces lower income and lower assets, which we saw on that last slide where we looked at the layers. Most companies use LIFO in times of rising prices, and this is because accountants are often conservative and they don't want to estimate income or assets, so they want to make sure that they're underestimating those two. And then also lower incomes means lower taxes, which means higher cash flow. And we always want to minimize taxes. We want to minimize the amount we're paying to the government. So what we're going to do now is we're going to go through an example. First one of LIFO and then of FIFO. So here we have the concept of we have this beginning inventory here that is made up of 3 layers. One that was bought in December, one that was bought in September, and one that was bought in June. And you can see the prices have been rising, $2.50 in June, and now it's $3. And so the total value of the beginning inventory we can just calculate out by taking 2,000 times 3, etc., to get to $12,350. So that's where we have this inventory value in the T account. In January, we went ahead and purchased 1,000 units at $3.10 a unit. So we have that purchase here of $3,100 showing. And also in January, we sold 3,500 units. So again, this is LIFO calculations here. So we're going to take the last in, first out. So the first ones we're going to get rid of are the last ones that came in, which are those that came in January. So we're going to take 1,000 of those that are at $310 price. But we're actually selling 3,500, so we need to go to the next layer, which are those that were bought in December. And there's 2,000 of those at $3 a unit. And that's still not quite 3,500. We have to take another 500 out of this 1,500 item layer, which is at $2.90. So that gives us a total cost of goods sold at $10,550. So that's where I have this number here as a credit to the inventory. And if we look at this on a per unit basis, it would be $10,550 divided by 3,500. And then the next question is, well, what is the ending balance in inventory? There's 2 ways to calculate that. One is to look at actually what are the unit balances. So if you remember, we took 500 of this item at $290, so there's going to be 1,000 left there. In addition, we never really drew down this layer, so we're still going to have 800 at $250. So 1,000 at $290 plus 800 at $250 is $4,900. That's also equal to $12,350 plus $3,100 purchase minus the cost of goods sold of $10,550, and that's $4,900. Now we're going to look at the same example but under a FIFO system. So in this case, we still have the same 3 layers. The beginning inventory is still that same amount. We purchased, again in January, we went ahead and purchased 1,000 units that gave us an additional 3,100 here. But we sold 3,500 just like before. But in this case, we're using FIFO, so we're looking at the oldest items here. So the first layer we're going to look at is this 800 units that are at $250 a unit. So the second layer is we actually have to get 3,500, so we have to take all of this 1,500 at $290. And then for the third layer, we actually have to go into this most recent layer, well, not the most recent layer, the one in December, for 1,200 in order to make this add up to 3,500. So we get that calculation at $999.50. And if we do that on a per unit basis, it's $2.84. And just going back here, in the LIFO example, it was $3.01. So you can see that it's actually cheaper, the units are cheaper in a FIFO sense. So that would mean that we'd make more profit if we use FIFO. And the last thing we want to do is figure out the ending inventory. This value is wrong. It needs to be 5,500, and I will change that on the PowerPoint. But if we look at this, what we did is we went into this unit we took 1,200 of those, so that means we're going to have 800 left at $3 a unit. And then we didn't go into this most recent one we bought in January, so we're going to have 1,000 at $310. So 800 at 3, 1,000 at 310 is 5,500. Or we can take the 12,350 plus 3,100 minus 9,950 gives us 5,500. So that's a simple example of the difference between LIFO and FIFO inventory calculations and how it affects both the ending inventory value and the cost of goods sold.